Hello and welcome to Avalara's webinar on 50 years of VAT, past, present and future. I'm Alex Wolf, Senior Director of Global Indirect Tax with Avalara. I have just over 17 years experience within UK VAT and Global Indirect Tax. And today I lead on Global Indirect Tax with Avalara, tracking the major changes across the globe and advising our business about how that impacts our products, our customers and our partners. And I'm really pleased to be joined by my colleague, Matt Harrison. Hi, Matt.
Hi, Alex. Look, it's great to be here to talk about this subject. Both introduced before we were even born, but it's great to be here. And just a bit of information about myself. Been in tax technology for just over 11 years now. Worked for a couple of different companies in the mid-tier and obviously for Avalara. My predominant role here at Avalara is looking after our VAT solutions and e-invoicing sales team, and kind of helping businesses with their solutions and helping them along the journey of the evolution of the tax technology evolution that we're kind of currently seeing at the moment. But yeah, really great subject. Interesting just to have a great chat about 50 years, that only which of 20% I've been a part of. So it's great to be here, Alex.
Thanks, Matt. Yeah, absolutely. I was just thinking the same thing. We've obviously been involved in the VAT industry in different guises, for a couple of decades. But I think it's fair to say that we've seen a lot of the technological changes. HMRC's drive around making tax digital, and we've seen a lot of differences in the approach to audits, compliance in general. So yeah, really looking forward to this chat. So firstly, a very high-level background on Avalara. I hope you know who we are already, but if you don't, we are a global tax technology company, headquartered and founded in the US out of Seattle, but today very much a global company. Our EMEA headquarters is in Brighton in the UK, but we have multiple offices across Europe, including in France, Belgium, Germany, Luxembourg, Spain, Romania, Turkey. We seem to open a new one every month, so I'm sure I've missed one. We have solutions across the indirect tax compliance cycle, helping our customers achieve compliance, reduce risk, and streamline processes. We support over 30,000 different companies globally, and one of our huge strengths is that we have pre-built integrations into a number of different systems, ERPs and marketplaces, in fact, over 1,000 globally. So Matt, could you provide a bit of an overview in terms of our product suite and how they support VAT compliance across the life cycle?
Yeah, I think it's important to explain where we came from and where we are today. So as you kind of mentioned, born out of Seattle in the US, it's interesting to know a lot of people know us for our sales and use tax software. And just over the period of the last kind of 20 years, we've just gradually acquired companies and built solutions to kind of fit the whole landscape all the way through from registrations. This is kind of the registering in different regions, but also kind of helping people understand the research behind that. So understanding where they need to be registered and stuff like that. The product classification, so understanding when businesses are shipping goods, of how different things are classified. So these are some of our more recent tools. Obviously, we talked about determination, but we've got a global determination tool where we're covering a large range of countries across the globe. And one of our latest acquisitions was Avalara, was the e-invoicing acquisition. Now, we acquired a company a couple of years ago, and it's kind of revolutionizing how we as a business are kind of working and bringing everything together under one umbrella. So the determination, e-invoicing and returns piece. And that kind of finally leads me on to the returns piece, where we've got multiple offerings here where we do like a supported offering. We provide the software to facilitate it. And we've got a large coverage of over 60 countries where we're able to provide this reporting. So the whole life cycle from start to finish, we have differing offerings in different regions, and it's it's great to see that, like you mentioned, we're obviously growing every day, and growing offices means we're always looking at growing content, growing the technology with each of the different regions, to really truly provide that whole life cycle thing for as many countries as we possibly can. As you know, our main goal is to be part of every transaction in the world. An aspirational one, but definitely something we're going to need to do if we're going to build out this portfolio. Something we need to do is build as many of the things around that fit the different pieces in different parts of the journey, that goes from kind of the transaction all the way through to the reporting.
Thanks, Matt. Really, really interesting, and I know you've been part of this journey. What really impresses me with Avalara is the scale. There's some stats on the screen now. We processed and filed more than 4.1 million returns in a year. And the Avalara tax engine actually received close to 34 billion calls to the API. So really powering a lot of global commerce and helping businesses stay compliant. So before we deep dive into UK VAT, I just wanted to set the scene with a very short, brief history of the VAT system. So VAT was actually the brainchild of a German industrialist, Dr. Wilhelm von Siemens. So he had this idea that VAT was a very efficient system, charged and collected by businesses, in effect being unpaid tax collectors. And because VAT was charged at every stage, even if there was non-compliance, someone didn't charge at a stage, there was still VAT collected, because there would have been, in effect, VAT paid to the earlier party in the chain. But it was actually first introduced by the French, Maurice Leray, with the name taxe sur la valeur ajoutée. So tax on the value added tax, that's where the name comes from. The VAT system was properly introduced in the European community in 1969. In January that year, the very first VAT directive was transposed into national legislation, so across the founding members of the European community. And then, just 4 years later, in 1973, when the UK was joining the European community, it was a prerequisite to bring in the tax. So Anthony Barber, who was Chancellor of the Exchequer at the time, hailed the introduction of VAT as a simple tax, a quote that is often dragged out by advisors, by lawyers, often with a wry smile, because 50 years later, it's not simple. The amount of additional legislation, guidance, ruling requests, the amount of cases that go to tribunals, the amount that's spent on advisors, a whole industry has been born. And that's actually, quite an interesting first angle, because, when the VAT system was first introduced, maybe for the first decade, almost 2 decades, there weren't that many VAT specialists. It became something that was just looked after by a tax generalist, something maybe by an accountant. And it was really, in the 90s that the big four, or the big 10 as it was then, started investing in VAT specialists, started hiring people from revenue and customs. And today, it is a prerequisite. If you are a large business trading in the UK, trading globally, you will have indirect tax function, you will have VAT specialists, and more and more VAT specialists with a technology data hat on. And we're going to talk about that a bit later on.
Yeah, and that's what I was going to lead on to, Alex. I think that tax specialism has evolved over the last few years. I think originally it was someone that just understood VAT rules within that region and maybe had an understanding about VAT rules in a different region. It's now transformed into how does it work in the technology world, because it's another parameter that's kind of has to be considered. It's not just tax anymore. It's how do we meet the technology needs that tax offices are enforcing on businesses going forward? So like you say, it's anything but simple. Like the concept of tax is simple, or the concept of VAT is simple, but the actual delivery is much harder than the concept.
Absolutely. And from those beginnings in 1918, an idea of a German industrialist, there's now a VAT GST system in over 170 countries around the globe. So it's actually far easier now to list the countries that don't have a VAT system that do. Somewhere like Hong Kong, Iraq, I believe, Syria, and of course the US. The largest economy without a federal VAT system. They of course have state and local sales tax, and there are actually over 10,000 different tax jurisdictions. But we're still seeing implementations today. I spent some time in the Middle East and in the Gulf region and the GCC when the UAE and Saudi Arabia were the first countries to implement in the GCC, and we've seen other members implement in recent years too. But it is the indirect tax of choice now, and rates are only going one way, and that's up. So I wanted to share this quote because the first quote of VAT being a simple tax, fast forward a couple of decades, and this is from a judge in the Court of Appeal of England and Wales, who described in a decision VAT as a kind of fiscal theme park in which factual and legal realities are suspended or inverted. It is far from a simple tax. And in fact, you only have to look through some of the BBC headlines from recent years about capacity tax, very interesting or rogue decisions of tribunals on lots of different food items. Of course, the famous Jaffa cakes. Is it a cake? Is it a biscuit? There are a lot of followers. It's led to a lot of comedy sketches. But VAT will continue to evolve, I think, from a policy perspective, legislative perspective, and a lot of that will be driven by technology, by data. And Matt, just something I wanted to pick up on what you said. I think it is becoming more of a business issue. Historically, VAT was more of an accounting issue, a reporting issue, maybe an end of the period responsibility. Prepare the return, review invoices, prepare for a tax inspection. But the reality now is, VAT and business process are really aligning. If you don't get the VAT right, goods may get stopped at the border. If you don't factor in the right rate of VAT, there's an impact to pricing, to margin. It really is, a real business issue.
Yeah, I mean, I can say at first hand, we're seeing more teams involved in these types of decisions. I mean, we may have only typically seen a couple of stakeholders, maybe in the tax team and finance team originally, but now you're getting much more depth into a business. There's usually like 3 or 4 different teams involved in these kind of discussions because they've all got their different kind of different stakeholders, different kind of elements they need to consider when they're implementing these types of solutions, because everything is moving towards more real time. And so when we move more to real time, it means that everyone is concerned about who integrates with the what and what systems and what feeds what. And it just becomes more important for the likes of the security team, the IT team, and all of those different, there's other different teams that kind of start to get involved in tax, which probably has.
So the rate of VAT has really shot up in the UK. So VAT was introduced on the 1st of April 1973, April Fool's Day, but it wasn't a joke. And when it was introduced at a rate of 10%. And that slowly crept up to, in effect, a doubling of the rate, since January 2011. There was a slight reduction when it went down to 8% the following year. This was a very short-lived experiment with a 12.5% additional tax for petrol and luxury items, and an alternative VAT rate of 25%. But really, it just kept on going up. So 8% to 15% to 17.5%. To a lot of people, that is still the VAT rate. That's the number most people think about. It was then reduced in the credit crunch to help improve cash flow for businesses, a shot in the arm for struggling businesses around that time, before returning to the original 17.5%. And then a year later, up to 20%. So this is probably, the median, the average, when you compare it against other EU member states. Of course, the highest rate is Hungary with 27%. Be interesting, would a future government look to increase the rate of VAT? Obviously not very popular politically, but would have a significant impact on the tax take. Could that be used to increase government spending? Let's see. Obviously nothing announced in the last budget. But I think as a general rule, the general direction of travel is increasing standard rates of VAT. Governments are still trying to claw money back post-COVID and fund the post-pandemic recovery. But as well as just that headline rate going up, Matt, I wanted to chat to you about the idea of the importance of getting VAT right first time, and how this increase in the VAT rate also increases the impact of getting VAT wrong. So could you kind of talk about a few examples there?
Yeah, so where we move to more real time, if the governments are going to start auditing quicker, it means they're going to start picking up on mistakes quicker. And then obviously it's going to affect on things like margin, because you're going to have to consider that maybe you didn't charge the correct rate in the beginning and you have to charge a different rate. Or possibly you're going to have to pick up some penalties. And this move more to real time, it means it's going to really impact like cash flow and stuff like that, because hopefully it should have the improved effects. Like we'll see later on in the presentation and talk about some stuff later on, but the move to more real time hopefully means that you'll invoice quicker, you'll receive the money quicker, and therefore be able to run the business more consistently than potentially you do today. But some of the pitfalls might be around product classification. We see this on a regular basis on our side. Like there is, like you were saying, tax is simple. Like the rates, there's only 3 of them in the UK, but understanding the different things like biscuit versus cake and how that can potentially change the VAT rate significantly, understanding those pieces becomes incredibly important. And when you're trying to look at your products, look at the transactions you have today. And yeah, so all of these things become more important. It becomes more of a strategic decision for businesses on how they run their tax team. So we often see like businesses that have got rates and they say, well, our rates haven't changed for a long period of time, but tax rules are moving all the time. So if you've got something in there that you've been not checking year over year, you could potentially be charging the wrong rate because things are changing for the different types of products. Like some of the things we're seeing moving in the industry, like there's new stuff happening all the time, the likes of NFTs and the likes of crypto, and we're seeing these things pop up, and the tax offices aren't sure sometimes how to treat them themselves. So there's sometimes like that ambiguity can cause future problems. So those are kind of some of the things that the businesses are battling with, kind of, and sometimes the benefits of moving to that more real-time experience.
Great, thanks, Matt. Yeah, completely agree. And sometimes if things go wrong, you see complete margins wiped out. And if you compound that with interest, penalties, the assessments from tax authorities, it can have a huge impact. And particularly when HMRC can go back 4 years as well. So huge commercial impact there. And businesses need to get it right first time at the point of sale.
Yeah, and typically in audits, you generally see businesses over recover and undercharge. It's generally not in the tax office's favour, and that's where obviously we get the VAT gap from. And so it's interesting that it's predominantly in the business's favour, those mistakes that are made. And I think what we're going to see is that move towards having to be more real time and reporting on a regular basis, and maybe the introduction of e-invoicing. You're going to see those errors highlighted quicker and faster, and maybe penalised when they probably weren't done in the past, unless there was a physical audit.
Great, thanks, Matt. So
I think it's important to talk about how things have changed and how they're changing now. The UK has maybe not seen as much of this change. We've only seen a flavour of e-invoicing brought to the UK, but the world is moving to this way. So, I mean, we originally started with handwritten receipts. I'm not sure I was around when there was too many handwritten invoices, but that is kind of where we started. I think, many of my finance roles, I can say that I've definitely printed an invoice and posted an invoice. I'm sure you the same, Alex. And obviously we've kind of moved slowly towards that kind of model of using less paper, so therefore trying to move towards a PDF model and sending emails, but even that comes with its challenges because of the different formats and trying to conform and trying to understand what they're saying and the time spent sending data back and forward. And so what we're seeing is obviously this transition to the e-invoice. And so, Alex, and this is your area of specialty, so I'm definitely going to lead off with you on this. So UK's got a flavour of it today. So they've got NHS procurement has that PEPL involvement, and you have to do B2G invoices through that PEPL network. Now, there's no doubt it's coming, but it'd be good to understand, and help everyone understand, what's the difference between what we've had in the past and what will be the future.
Yeah, no, thanks, Matt. Completely agree. What an invoice looks like, its contents, its format has really evolved. Over the last 50 years. Today, a lot of businesses use PDFs. They will either create that through the ERP. Some people will have templates in Excel using spreadsheets, as a Word document. But in reality, what we're seeing globally is a PDF just doesn't cut the mustard. It's not really seen as an e-invoice. And the European e-invoicing directive that was issued for public procurement, and what we've seen proposed in VAT in the digital age, or VIDA, is a standard PDF is not an e-invoice. It needs to have structured data and can therefore be machine read. So, we're looking at a move away from anything paper, anything scanned, the use of even OCR, getting rid of manual processes in that invoicing process, moving to something that is structured in nature. So, looking at an invoice that can be read by a machine, sent, exchanged by computers. So XML language, couple of flavors there, the CII, industry invoice, or UBL, the universal business language. There is a hybrid version because, of course, invoices need to be read. They need to be viewed, interpreted, posted, paid by people, AP functions, procurement, looked at in case of audit, internal audit, inspections, other use cases. So for that reason, we're seeing an increased uptake in the PDF A3. So this is a hybrid document where it's a PDF to the human eye, but it's actually embedded with XML, so it can still be processed and read in an automated fashion by a computer. And just to pick up on something you said earlier, yeah, the NHS procurement, NHS England, that's one of the niche use cases within the UK where e-invoicing is currently required. So that's a requirement under NHS procurement rules. You can use the PEPL network to generate and share an e-invoice, and Avalara is part of that four-corner network for PEPL. We are a certified PEPL service provider and can help businesses comply there. But no mandate today, no real noises or appetite, it seems, from the UK government or HMRC to mandate e-invoicing. Although we are going to see it very soon within the UK because of Northern Ireland's unique relationship with the EU post-Brexit. It needs to follow the EU VAT rules for supplies of goods. And under VAT in the digital age, there will need to be e-invoicing for any intra-community supplies from January 2028. Still in draft, it needs to be approved by the European Council, but that should happen within the next 6 months. And just 2 months ago, the Treasury issued a policy paper on the impact to Northern Ireland, so recognising that Northern Ireland will be caught by many of those VEDA proposals. So actually, we may see businesses in Belfast having to adopt e-invoicing and digitalise much quicker than those businesses based in London.
I was thinking, Alex, surely this is the next step after MTD, the introduction of MTD. Surely this is the next step for the UK government, that they're going to introduce this alongside, obviously, with VEDA coming for Northern Ireland businesses. They're probably not going to want too many different processes in place for regions across the UK. So, do you think it's going to be on their agenda? Have you? I know you're very close to this. Have you spoken to anyone in the UK government at all?
Well, you really hope it would be, because it's the clear direction of travel globally. Virtually every government tax authority globally is looking at this now. So, I'd imagine the UK government is on the agenda. Increased digitalisation definitely is, reducing the cost of business for SMEs. HMRC, are very serious about closing the VAT gap, raising revenue, reducing fraud. At the moment, that seems to be more focused on non-resident businesses. Looking at Chinese businesses selling through e-commerce channels. So, at the moment, no real clear signs, no public consultation, no draft legislation. And in fact, I did hear a joke the other day that the only reason that VEDA, was passed at this stage and got full consensus within the European Parliament and was adopted is because of Brexit. The UK left, and maybe the UK actually had some reservations about this new digital reporting requirement and mandatory e-invoicing. But let's see. Fingers crossed. It's either going to be a case of the UK mandates this, or businesses just naturally will start adopting. And you talked about the difference between different parts of United Kingdom. Maybe Great Britain and Northern Ireland having different rules on e-invoicing. But today the world is a much smaller place, and businesses trading internationally, importing, exporting. Some countries have e-reporting requirements that equally non-resident businesses. The Spanish SII, the Hungarian real-time reporting, and indeed France next year. If you make B2C supplies in France under a French VAT number, you will also be caught by e-reporting rules, regardless if you're a resident business or not. So I think businesses will want a common single approach to invoicing. I think they will start adopting e-invoicing on a voluntary basis. it's just whether the UK looks to legislate that more, mandate it, or even incentivize. In countries like Singapore, we're seeing the Singapore authorities offer grant funding to SMEs to actually adopt e-invoicing. They can be paid up to $1 per invoice they issue and receive electronically. In Australia, for business to government, the government department would actually pay the business within 5 working days if the invoice is sent via the PEPL network. There's also some grant funding in the billions in Spain that's available to help digitalize accounting systems, including invoicing. So lots of great examples there. Different drivers, different timescales. But if we're talking about the next anniversary, even in 5 to 10 years' time, I'd be very surprised if the UK hasn't joined the rest of the globe. And just to illustrate that point, we have a diagram up on the screen now from our friends at PwC, just showing this clear direction of travel. Showing that governments across the globe are introducing more digital tax reporting requirements. You will see the Union Jack there. That's not really UK e-invoicing, it's more making tax digital, but it is seen as at least a baby step in the road to digitalization. And Matt, I know we're going to talk about MTD in a bit more detail later.
Yeah, I see MTD as such a light version of e-reporting compared with a lot of the other e-reporting that's out there. So again, I think MTD, current MTD, is just phase 1 of the UK government's plan.
Absolutely. I've always seen it as a prerequisite step. It's getting people used to working with APIs, the ability to create a JSON file. I think more importantly, it's the process businesses went through. It was reviewing systems, how data was transferred, where the data came from, was it complete, kind of creating a minimum data set of the VAT records for each transaction, for each invoice that need to be kept and maintained, and trying to reduce simple transposition errors in the preparation of the VAT return. And I think that's really good work ahead of broader digitalization, broader e-reporting, or e-invoicing. I just wanted to show a bit of a flavor of where we're seeing these e-invoicing mandates. The last 10 years, it's really been Latin America that's led the charge. Brazil first introduced e-invoicing with its SPED system over 10 years ago. Soon followed by a lot of other countries in the region. And really, whenever we've seen e-invoicing in Europe in the last decade, it's tended to just be business to government. And within the last couple of years, there's been an absolute requirement, under European directive, with direct effect for all government bodies to be in a position to receive e-invoices from customers, from vendors in Europe. So, if a business wants to adopt PEPL, wants to issue an e-invoice, the government needs to be in a position to receive that. So, it's going to be interesting to see if the PEPL network is adopted much more broadly within the UK, and if more government departments incentivize its use. But looking ahead, 2024 next year is the big year in Europe for e-invoicing. We're going to see mandatory B2B invoicing in Poland, France, Spain, and now looks like Belgium is going to introduce it at the same time. And then we've got Romania, Slovakia, a number of other EU member states who will be on the tails of that, maybe 2025. And then, VIDA, mentioned before, currently proposed that from 2028, there'll be mandatory e-invoicing for cross-border intra-community supplies, and that will underpin real-time reporting of those transactions by both the supplier and the customer. And that, at the moment, will equally impact businesses in Northern Ireland.
And so that kind of leads us kindly on to the next subject. So we talked about invoicing, and now we can see the move from analog to digital for the reporting. So I think, I mean, I'm sure you were the same, Alex. I remember a long time sort of being involved in filing returns and helping on those different pieces. And I can remember to this day, we still had to file the Maltese VAT return by post. And that didn't seem crazy to me at the time, but it seems crazy to me now. I remember interacting with the German tax office by fax. Like it's all of these pieces that kind of it really puts into like how much it's changed in the past 5 to 10 years. I think when it was introduced, there was obviously a lot of change that happened and a lot of stuff that was being introduced and implemented. And then we kind of, I would say, hit this kind of slow period where things kind of stayed still. And now we're kind of hitting this tax technology revolution. So gone are the days of post and fax. We're now looking at the days when it's kind of automatic submission through things like MTD. I mean, you can do the similar kind of scenario with the German tax office and the Dutch tax office. So all of these automatic submissions, I think, are going to become more prominent as we kind of move towards the future. So MTD is a great example of just bringing that whole submission piece away from filing a return and sending a return and having it through an automated file piece. And so as we introduce this e-reporting, we might see the transition of the VAT return. So Alex, I think you mentioned it earlier on about maybe pre-filed VAT returns and elements where we might not even have the VAT return. So a couple of regions like Norway and Poland have ditched the VAT return in replacement for e-reporting, and I think we're going to start seeing a lot of those kind of introductions where instead of there's no longer need for paper or for fax or even for you to click submit potentially. There's going to be automated filing systems of large scale pieces of data that the tax offices are going to have ready at their fingertips to compare with each other. So I think the interesting thing for you, my question for you, Alex, is how do you see like the UK tax office developing? Do you think that they're going to introduce more e-reporting given the fact that they've got introduced MTD? Or do you believe that we're going to still see the traditional VAT returns that survive for a long period of time?
It's a good question. And in fact, I'm old enough when I was a fresh-faced graduate, actually corresponding with HMRC via fax and, completing some VAT returns in hard copy, mailing those, recorded delivery to HMRC. In fact, once I think I actually hand-delivered one on deadline day. So it's been interesting to kind of see that, evolution, from the online web portal, the move to API, submission, via a JSON file. But I think it's important to realize that, this isn't just a digital journey for the taxpayer. HMRC as an organization, as a major employer in this country as well, has also been on its own digital journey. It's really invested in an IT and finance transformation project. I believe HMRC is now the largest customer in Europe for SAP. They're really ramping up their technology infrastructure, how they use that, internally in terms of managing its workforce, but also gearing up to receive more data from taxpayers. And, the API submission, it's just changing how that data for the VAT return is received. But it's two-way. So it's how HMRC then, send messages back. I think that will evolve. I think it's interesting that HMRC didn't change the granularity of the VAT return. They didn't add additional boxes. In fact, the irony is the number of boxes for most businesses has actually been reduced, post-Brexit. So HMRC is nowhere near getting more granular transactional level detail. if they want that, and sometimes they do, that's normally requesting data, but shared in various different ways. Often some tax authorities will want you to use some file sharing software. I've seen sometimes HMRC will use more sophisticated means to transfer that to. But I think that will continue. I think HMRC officers are getting more tech savvy, more data savvy. They're getting more familiar with different IT systems. Many people on this call will remember IDEA software, still used today to do data mining, data interrogation. That was actually developed, in conjunction with a major accounting firm, Grant Thornton, I believe, together with the Chartered Institute of Accountants in Canada. But that was, soon adopted by HMRC and has been used by a number of years. But I think the next stage of MTD, maybe it will have a different name, a different project. It will be around transaction level data. It will be more real-time reporting. I think we'll see the gradual move away from that summary level return.
Yeah, and that's the thing I was going to say is there's no doubt. I'm not sure what level of granularity or any data they've kind of got from moving towards MTD. I feel like it's just the kind of the setting the blocks for businesses to be able to move to something more sophisticated in the future. I feel like they're probably not getting the full value out of what they've implemented so far. So there's absolutely no doubt that they've got a bigger plan in mind, and there's something that they're going to introduce in the next few years. So I'm interested to see what it will be. Hopefully it will be a bigger, well, I say hopefully, I think it will be more around e-reporting and maybe less around e-invoicing, given some of the stuff we've seen. But yeah, it'd be interesting to see what they end up doing. Next slide.
Absolutely. Watch this space.
Yeah, exactly. So I think we've talked about invoicing, we've talked about reporting, and now we're going to talk about the secondary thing of both of those two things. So audits. Well, everyone loves audits. The way this is going to change is massive. So I think we're going to see further adoption in the EU of this before we see adoption in the UK, but there's no longer going to be those in-person audits and inspections. They're going to be happening real time. The likes of Spain, we're introducing SII, where transactions are being sent every 4 days. This is going to become the norm. Every maybe 2 to 3 days, or every whatever the allotted time period will be, you're going to see more of this. We're going to see more of this introduction of more data, more regular, and more checking, so that whole role of an auditor is going to completely transform into being a more technological-based role. So it'd be interesting to see how that role transforms from an internal perspective and from an external perspective, because things are going to change, and it might be that where you have these internal audits, they're able to be done like on a regular basis rather than just periodically, maybe once every 2 years. So it's be interesting to see how all of these different departments kind of develop with the move to tax technology. Great to get your thoughts on this, Alex.
Yeah, well, I mean, first of all, I wanted to talk about the cartoon. I love this cartoon. I used to use this when I was based in the US, educating Americans about the VAT system, and this was always a great icebreaker. No, it doesn't stand for vodka and tonic, but this is kind of the old-fashioned view of a tax inspector. They would often appear unannounced. Maybe it's a scheduled meeting. Very much in person. They would spend time on the premises. They'd be looking at bank statements. They'd be looking at accounting records, but probably looking at everything on a sample basis. That's completely changing. It's changing already. very few businesses have dedicated contacts now. And even the largest businesses that do in theory, that they often change. And HMRC, like a lot of tax authorities, is moving more to a risk-based approach. When returns are submitted, even though it's still very high level, summary level detail, there'll be algorithms, there'll be red flags on the screen. When an input tax credit seems large, maybe it's the first repayment, maybe the kind of effective ratio between different boxes just doesn't look right. But I think this will continue. As HMRC eventually get more data, for via e-invoicing, via e-reporting, perhaps just through information requests, they will be performing more analytics. They will be really trying to focus on errors, on issues, really trying to identify fraud. So, I really think we'll see a move away from not only periodic reporting, but periodic VAT inspections. And, maybe this cartoon is a thing of the past. So, Matt, getting towards the end of the webinar now, I just wanted to get your thoughts on the future of UK VAT. I know a lot of people will, be thinking about, changes in rates, changes in VAT policy. Are there kind of new Brexit freedoms, that government may have, to apply reduced or zero rates. But I wanted to kind of focus this more on the technology and data side. That's been the focus of our discussion. What do you think we might see?
So what we've seen recently in the market is them really focus on B2C. They're looking at how they can reduce the gap, because I think the majority, they believe, is down to the B2C models that exist today, and the fact that it's very easy to sell marketplaces as non-residents, and it's very easy to ship goods as non-residents, and kind of go underneath the radar. And so what they're trying to do is potentially look at the models where they can actually, rather than target the individual sellers, target the bigger providers that have maybe a stake in the ground, and have more kind of physical locations, or even have a chance to be part of a transaction before it even goes to that individual business. So I think we look at here is there's some market facilitation laws. So that was introduced as part of, well, not as part of the Brexit, but as Brexit happened, we were already in consultation with the EU, and it was introduced 6 months earlier than the EU. But marketplaces are now responsible for non-resident transactions when they have a marketplace in the UK. So that's the UK tax office saying, I don't want to chase 5,000 or thousands and thousands of sellers. I would rather just monitor a marketplace, look at the transactions. Again, like you were saying before, does everything look right? Oh, are they collecting what they say they're collecting? Are they actually reporting the revenue correctly? It's easier for me to check a marketplace because they will have hopefully processes and technology in place that we can do those checks. So that's one piece. And obviously the other piece is the split payments. And so we've seen this in a number of regions across the world, but credit card companies being targeted to take the VAT portion before it even gets to the business, so that what happens is there's no involvement in the business. There's no ability for the business to become non-compliant because they're not even receiving the VAT. It's going straight to the tax office. So it's interesting to see all the different strategies around the world. And I think what we'll see is just there'll be a good strategy and countries around the world will adopt that. And I think we'll start seeing some of the things I think about the split payments in the UK and how it's being talked about, how it can be introduced. It'd be good to understand how close you are to that, Alex, because I know we were having a chat about this the other day.
Yeah, so there's been a public consultation on this. It's certainly an idea HMRC have to reduce fraud, particularly for non-resident commerce vendors. We've got this almost irony that there's a zero threshold. That the threshold was reduced. If you're a non-resident the first sale is taxable. So on one hand, you're saying every business in the world who, makes a few sales in the UK has to register. You have to, register to bring goods in. Even if the marketplace is ultimately, going to be making the sale. You want a VAT number so you don't have the cash flow impact of import VAT. But then, because of this perceived risk of fraud, by a minority of overseas businesses, it's become very difficult to obtain a VAT number. The burden of proof, the additional checks, the evidence that a supplier, listing on a marketplace needs to provide is increasing. And I think split payments is looking at that as well. It's again more focused on non-resident businesses. Maybe looking, not at Europe, but further afield, Latin America. But I just wonder if all this attention's on there, where is the ambition about further digitalization, for British businesses? Will we see that soon? Will we see further simplification of registrations and returns? Almost the opposite of what we're seeing for non-resident businesses today. Would it be easier to register? Are we going to have portals where businesses can do that, where they can obtain a number quicker? Maybe more automation on the side of the tax authority, maybe simplified returns.
Yes, that's what I was going to say, Alex. Like, it's interesting the strategy that they've placed here. So having that nil threshold automatically means that obviously everyone needs to be registered. They haven't really put, I would say, the facilitation in place that some of the other countries around the world have. So I think Australia is a great example of this. Like, they put in a nice simplified process to be able to register and report the tax. And they've tried to reduce the barriers as much as possible because they know the less barriers, more businesses will comply and obviously register. And so I think that is something that maybe needs to be relooked at. It's great to have a nil threshold, and try and include all businesses, but you have to reduce those barriers. I think speaking to the registration team, it's become incrementally harder to get registered in the UK post Brexit. So those are the sorts of things the tax office need to consider about reducing to try and increase that tax collection. So nil thresholds are one thing, but actually it's more around the process you put behind that. It should be more streamlined registrations, more streamlined returns potentially, so that like the likes of OS and IOS, like those streamlined returns allow businesses to comply quicker, easier, and pay the tax over, which is the thing that the tax officers are most concerned about, is getting the right amount of tax. Absolutely.
Some really, really good points there. We've talked about e-invoicing, whether that's coming, maybe, but not in the immediate future. MTD next steps. We've recently heard that the next wave on the corporate income tax side has been delayed. But like I said before, really interested to see where HMRC go next on the VAT side. So that wraps up the end of our 50th anniversary webinar. I hope you've enjoyed it as much as I have. Catching up with my friend Matt. Always good to chat to you, Matt.
Yeah, it's great to catch up on 50 years. It's been such a kind of turbulent time in the recent years. There's been a lot of changes, but it's good to look back and obviously introduce ourselves to kind of some of the old techniques that we used to use to see how far we've come in the last few years. So really, really interesting topic, and it's great chatting to you today.
Fantastic. Well, thank you everyone for watching us. Happy birthday, UK VAT. Cheers. Thank you.